As a global equity investor, what we hope to achieve for people in our fund is real returns over the medium term. And the way in which we go about achieving that is by trying to find long-term growth opportunities, growth themes, such as healthcare needs, such as automation around the world, invest in companies exposed to those themes when they're at reasonable valuations, and sell those stocks if they become too expensive to hold, and then try to make sure that we've got a well-diversified portfolio, both by sector and by geography, and that helps make the fund more resilient were stock markets to stop going up. Over the last 10 years, equity markets have done little other than go straight up. Real returns have been excellent, but we are preparing the fund for any turbulence ahead, especially as capital gains have been so good. So we try to make sure it's well diversified and that the average multiple of earnings across the portfolio hasn't gone up too high. And that way we think we can achieve real returns, good real returns, on a sustainable basis going forward. There are two companies that we've held since we took over the Wynd Investment Trust 5 years ago, which are pretty much what we want out of any company. Louis Vuitton, the shares have more than doubled over the last 5 years. The earnings have more than doubled over the last 5 years. The company keeps investing in new products, not just in the luxury goods area, but also in its wine and spirits business as well. So it's a good example of a very substantial, highly profitable business in good growth areas where the share price has been driven up by the cash flow growth over the years. Another example of that would be Thermo Fisher, which is perhaps a less well-known company, but is also one of the leaders in the world, but in scientific equipment. So their growth, which is even faster than Louis Vuitton's, has been due to demand from the pharmaceutical industry, but also from academic industries and people at the cutting edge of science. Everyone needs scientific equipment to invent new materials, new chemicals, and whenever they need equipment to develop research and development, they have to ring up Thermo Fisher. Half of what they sell is equipment, the other half is the reagents which go in that equipment, so quite a lot of the earnings are recurring and very high margin. The reason I like running a global equity fund with my two colleagues, Alex and Rosanna, is because the world offers all of the opportunities to invest in growth, whereas any regional fund, even a UK fund, you're limited to the stocks which are quoted in that particular market. So if you take some of the biggest areas of growth that we see going forwards, such as automation, Britain has a number of decent automation companies, but most of them aren't quoted. Whereas Japan has a large number of the world leaders in automation. They're all quoted, and so we can invest in them. And there are also a number of new companies coming through, even in countries like China are now making decent quality automation equipment at a lower price, lower quality, but they'll catch up fairly soon. So there are two advantages here. One, you can always invest in growth opportunities, and secondly, you're looking at every industry with a global context, which is how industries compete. So your view of the dynamics of an industry is about the whole industry around the world, rather than just the bit of it that happens to be quoted in your own market. And I think that that combination, the growth opportunities, the ability to diversify globally, and also that understanding of the global trade dynamics and the global industry dynamics helps us to put together a successful portfolio. Well, equity investing is a long-term business, and so when people choose to put their savings in our fund, they do need to take a reasonably long-term view, because our fund is what you call a long-only fund. We own shares. When stock markets go down, our fund will go down. We try to structure our fund so it goes down a lot less than the market, but bear markets can last 2 or 3 years. And so for our company's growth to beat the bear market, for the company's earnings to go up faster than the equity market goes down, I think a 5 to 10 year perspective is the right perspective to take when you're thinking about investing in our fund. And then I tend to encourage people to invest gradually, not to try to time the market. We don't particularly try to time the market from that point of view. So if people are thinking about putting money in the fund, often it's best to split the investment up and invest a little bit of the money, perhaps once a quarter over a reasonable period of time, not try to pick the lows and the highs. If we don't try to do that, I wouldn't encourage any of the public to try to do it either. The end of 2018 saw markets fall off quite sharply, partly because the end of quantitative easing, central banks stopped supporting the bond market in the way in which they had been since the financial crisis 10 years ago now. But also the world economy has been slowing a bit. So there's been quite a correction in valuations, which suits us very well. We buy growth companies. Our growth companies don't tend to be too affected by the economic cycle. And so seeing those shares come back to more modest valuations is very attractive for us. Markets have bounced pretty rapidly over the first 2 months of 2019, but all the same, a number of our biggest investments now are better value than they've been for the last few years. And so we think that there'll be pretty healthy real returns available this year and next year. But we're not complacent about this. The cycle has carried on a long time. Investors got very large capital gains. And so if you had, for instance, a rise in left-wing politicians winning European elections, that's the sort of thing which might frighten markets quite a bit, particularly, I'm afraid, if the Labour Party won in the UK. And so all the way through the next couple of years, we are going to pay attention to putting into the portfolio more defensive stocks which could cope with the market setback, just because the last 2 years have been so strong. So we do think that there are decent real returns to be had, but we also advise and manage the fund so that we try to protect the downside. I think that the theme we're most excited about is automation. Some politicians and some trade unionists are very worried about automation. They see it replacing workers, and that may well be true. It has been in the past, but it also means the productivity goes up, and so more wealth is created, and so perhaps jobs change. Automation is extending from being really about focused mainly on heavy manufacturing businesses such as car manufacturing, now into what you might call skill businesses, even robot surgery taking off now and having very, very good outturns compared with human interventions in some operations. So we're going to see a lot more automation over the next 5 to 10 years. We have about 15% of the fund exposed to that theme. We think it'll take a very long time to play out. I can see this trend carrying on for a decade at least. It's related also to machine learning, big data, data analytics, autonomous driving, all these other things. All these trends really in their infancy. To invest in them, most of the companies well exposed to that theme are in Asia, particularly Japan, which is the world leader in robotics. There are a few companies in America. And I would mention we still have half the portfolio in America. And while the newspapers tend to say that American equities are clearly very expensive compared with European equities, in the themes we invest in, we don't find that. We find American companies on, not cheap, but on sensible valuations given how profitable they are and how good their growth prospects are. And that, to our mind, justifies still having really quite a heavy weighting towards the US as well.